Hey team, it's Accounting Fundamentals, where the topic of the moment is more about T accounts. There's a lot more going on here. So this is the second information session about T accounts. So I want to share a screen and tell you, where does the data come from that goes into T accounts? Well, it comes from the traditional journal template. Let me show you what's going on here. So in the journal template, we have like transaction January 5. This was a debit to equipment and a credit to accounts payable. We know in the traditional journal template, the third line, we give ourselves a little reference to what that was all about. We skip a line and then we start again. Debits go first, credits go second. Credits are indented in so we could see very easily what's happening. So it's a little cascade effect with the indents that happen here. So the T account, so T accounts are actually going to start looking like this, where we're going to have a T account for cash and a separate T account for food inventory and a separate T account for office supplies and a separate T account for truck and for marketing expense and for wages expense and ice cream machine and a T account for repairs and a T account for all the different accounts that we're touching on in the journal entry process. Okay, now this image here is in the course workbook. And when you get to this page in the course workbook, I really want us to spend a moment before we do anything and go, here's our little DC Adler grid, and create ourselves a little reference based on normal balance. So the normal balance for cash, which is an asset account, would be a debit side. So if we were to literally write the word A over here and the word balance right here, then it's a reminder that A for asset has a balance that's going to go here, because in this cell right here is the normal balance total. And same for food inventory. Inventory is an asset. So we write the letter A over here as a reference to ourselves. We literally write the word balance in here. And this is where we would sum total all of those references, because the asset has a normal balance of debit. When it came to expense, as an example, we would take the E, we'd write ourselves a big E right here, and we know that the normal balance would fall under the debit side. So we'd write the word balance here, and we'd put the dollar value right here. As a different example, the account title, the T account for repairs is also an expense. Same deal. Balance, normal balance would go here. If I use revenue to serve a different example, we would put the letter R right here to remind ourselves that this is in fact a revenue account. And then revenue has a credit normal balance. So we would also write the word, before we add any numbers in here, balance, and know that in this cell right here is where the dollar value is going to go. Because to reminder, in order to get the balance, we need to take the total of the normal balance side minus the total of the mirror image balance side, and the answer goes, that dollar value goes based on is the normal balance within DC Adler. Okay, so back to looking at the journal, which is where we get the traditional journal, is where we get the data from to put into the T accounts. So let me go back and share this document here. So the journal, which is going to look like this. So the T account for equipment is going to have on January 5 date, and it's going to have a debit dollar value of 3,500. So in order to build out the T accounts, the very first line item is we're going to find equipment. In this, using this example, we would find equipment on the T account page. We would find equipment, date at January 5, debit dollar value 3,500. Then the next one here, we come down here, we go to the T account for accounts payable with date at January 5, and we would, to the credit column, write $3,500. So we just go top to bottom in the traditional journal. We would then go to cash, date at January 9, we would debit $4,000. next transaction, we go to the unearned revenue T account, dated January 9, and we would do a credit dollar value of $4,000. Done and done. Go to the next one and so forth. We go to the January 10, we'd find accounts receivable T account, and we would date it January 10, and we'd put a $5,500 value, and then that entry from the journal would be made into that particular T account. Then we'd go to the sales revenue T account, date it January 10, and under credit, we'd add $5,500 and so on. So we essentially go through all the transactions that are in a journal, in the traditional journal template, and we take all of those and transfer them into the T accounts like so. So the question is, where does the data come from to go into the T accounts? Well, the T accounts are a visual representation of what's happened in every account. What's happening in every account is referenced in the journal. So we take the traditional journal, we go line by line, transaction by transaction. Once all those transactions are entered into all the T accounts, then we go about and we would do the sum, find the dollar value, sum total, the balance of that T account, and list it under the normal balance side in that T account. So back to share the document. Once all the cash transactions are in, dates to the left, dollars to the middle, under credit, far right column is the dates, closest to the T line is the dollar value. Since we already know that here's where our balance is going to be, balance is normal debit. We take the sum of all the cash debit normal balances, come up with a figure, and then add together all the credit balances. And the total of the debit balances minus the credit balances is the total of that particular cash account. And since we've already gone through and written the word balance goes here, balance goes here, down here in the example, balance goes here based on the DC Adler and our giving ourselves a reference as to what type of account that is, then we could go through top to bottom and complete out those balances to be able to keep it all straight. The T account, which is a visual summary of all the transactions that have occurred in a particular account, really helpful because it gives you that running balance and helps you see if anything is off target or misaligned along the way. So objective, understand a little more about T accounts. Objective met. It's the end.